Welcome to this simple market and economic update. My name is Jason Hamilton. I'm a certified financial planner and the founder of Keep It Simple Financial Planning. In this video, we'll discuss the bond market as the Fed prepares for its first rate cut by the end of the year. Let's get started. What you need to understand about bonds are that they're very sensitive to interest rates. So when rates rise, the price of existing bonds generally falls. We call this having an inverse relationship. So it's no secret. Bonds have really struggled the last couple of years due to inflation and high interest rates. So when rates jumped in 2022 due to inflation and rapid Fed rate hikes, bonds fell into a bear market. However, they then stabilized and have rebounded somewhat in 2023. But today, many of the factors that have driven bond returns are improving. So over the next few minutes, we're going to talk about some insights into the bond market and why it's important to maintain portfolio diversification in the months and years to come. All right, let's break this down a bit more professionally. This chart illustrates the annual performance of various bond market sectors. Each column represents a different year, with the best performing sectors at the top and the worst at the bottom. On the right side, you'll notice that the Bloomberg U.S. Aggregate Bond Index has managed to recover and is now flat for the year after facing challenges through April. This setback was primarily due to higher than anticipated inflation during the first few months of the year, which led to a decrease in bond prices. However, there are now indications that inflation is moderating. For instance, the most recent Consumer Price Index report showed that headline CPI remained unchanged in May, marking the first time this has occurred since July 2022. Although some areas, such as housing prices, continue to be persistent, removing housing prices from the core CPI calculation results in a year-over-year inflation rate of just 1.9%. It's important to note that improving inflation doesn't necessarily mean that prices will decrease for most goods and services. Nevertheless, this development is encouraging for markets as it suggests that we are gradually returning to a more normal environment, particularly once the Fed initiates rate cuts. Consequently, other segments of the fixed income market, including investment grade and high yield bonds, have also shown improvement. While challenges remain, the bond market appears to be stabilizing and adapting to the current economic climate. Let's take a closer look at this chart, which illustrates the federal funds rate alongside the Fed's projections for rate cuts. During their most recent meeting, the committee decided to maintain the current policy rates. However, they did revise their forecast, reducing the number of anticipated rate cuts for this year from 3 to just 1. The remaining 2 cuts have been deferred to 2025. These adjustments in projections are primarily a consequence of the higher than expected inflation experienced earlier this year. Interestingly, the market seems to hold a slightly different view, with expectations of 2 potential rate cuts, the first one possibly occurring in either September or November. Irrespective of whether we see 1 cut or 2, the key takeaway is that we are on a path towards the Fed reversing its policy actions from the past 2 years. If this reversal materializes, it could potentially provide support for bond prices, which tend to benefit when rates are stable or declining. However, it's crucial to keep in mind that the Fed's projections are not set in stone and are subject to change based on evolving economic conditions. A lot can transpire between now and the end of the year. Despite this uncertainty, this development is encouraging for long-term investors as it underscores the growing importance of portfolio diversification. By spreading investments across various asset classes and sectors, investors can potentially mitigate the risk and capitalize on opportunities that arise as the economic landscape shifts. As always, it's essential to stay informed, remain adaptable, and work closely with your financial advisor to navigate these dynamic market conditions. Traditionally, bonds have served as a balancing force in portfolios due to the tendency to move in the opposite direction of stocks. When the economy and stock market experience downturns, interest rates typically decrease, which in turn helps to boost bond prices. This inverse relationship has been a cornerstone of diversification strategies for many investors. However, over the past few years, this pattern has been less prominent, as recent market volatility has been primarily driven by inflation, which can negatively impact bond prices. This phenomenon was particularly evident in 2022 when the bond market experienced a severe bear market. If the macroeconomic outlook continues to improve, with inflation moderating and the Fed following through on its projected rate cuts, bonds could potentially benefit from a tailwind. Moreover, bond yields are currently at their most attractive levels since the 2008 global financial crisis, presenting opportunities for investors seeking income. Given these factors, it is more crucial than ever for both long-term investors and those who rely on portfolio income, such as retirees, to maintain a well-diversified allocation across both stocks and bonds. By doing so, investors can potentially weather market turbulence and capitalize on the unique benefits offered by each asset class. While this discussion merely scratches the surface of this multifaceted topic, I hope these insights have been informative and thought-provoking. If you would like to explore these concepts further or discuss how they relate to your specific financial situation, please do not hesitate to reach out. Our team is always available to provide personalized guidance and support as you navigate your investment journey. We look forward to the opportunity to work with you and help you achieve your financial goals. If you'd like to speak with us, you can schedule your complimentary retirement vision discovery call by going to keepitsimplefinancial.com/talk. Once again, that's keepitsimplefinancial.com/talk, or you can call the office directly at 8776-RETIRE. That's 877-673-8473. My name is Jason Hamilton, and I thank you again for watching.
Subscribe now.